I'll start from 0, sorry. So we are looking at assignment 1 for 2019, second semester. Now, Ria Limited is a company situated in Gauteng with a 31 December financial year end. The following information relates to some of the assets of the company. So the 1st of February 2017, they purchased a vacant land for 1.5 million. Ria Limited began with the construction of a manufacturing building on this property in 2017 financial year. During the 2017 financial year, the construction cost of 5 million were incurred on this project. So they only purchased the land without a building. Then they started a building the land, the building for a cost of 5 million in 2017. Then the building was completed on 31 January after additional cost of 1 million. So in 2018, there's an addition of 1 million. In 2017, there's an additional of 5 million. So the building was available for use as intended by management on the 31st of January 2018 and was brought into use on this date. On 31 January 2018, a residual value of 600,000 was allocated to the building, and the useful life of the building was estimated to be 30 years. So we need to take note. The date that we are going to start to charge depreciation is when the asset was ready for use. So it means that in 2017, there won't be any depreciation. There's only going to be an addition of the land, but no depreciation of the building. There's an addition of the land and also an addition of the building, but no depreciation. Why? Because the asset was not yet ready for use. Then the asset was ready as intended by management on the 31st of January 2018. That is the date that we are going to charge our depreciation. Now, the fair value of the land on 31 December 2017 and 31 December 2018 amounted to 1,750,000 and 1,875 respectively. So in this case, we have to check the policy of the entity in terms of how are they showing their assets. Are they shown at cost? So if they are shown at cost, you're going to take the cost amount as is. But if they are shown at fair value, the fair value of the assets is going to be 1,750 and 1,875 for 2017 and 2018 respectively. So therefore, there is going to be a revaluation of the land in 2017 and 2018 if the policy of the entity is to show the assets at revalued amounts. Now, at year end, 31 December 2018, the residual value and estimated useful life of the building remained unchanged. So no decision has been taken by the company to sell this property. So we are going to charge our depreciation on the cost of the building. Are we together? Because there was no change in the estimated useful life of the building. Then we come to the office block. The office block on the 1st of April 2018, they purchased a small block at a cost of 5,220,000. Land was 1,325. The building was that. They acquired this property with the intention to earn rental income from it. So if they want to earn rental income from it, what do we call it?
Investment.
Yes. So the first property, this one is property, plant, and equipment. The office block is investment property. We said investment property, it is property that is held to earn rentals or for capital appreciation. So this one is going to be disclosed under investment property. The manufacturing property is going to be disclosed under property, plant, and equipment. Are we together? Right? Then we come to, so the fair value of the land of the building were determined to be 1.4 and 3.9 respectively. So we have to check if the buildings are going to be shown at fair value or not. Then we have got machinery. During the current financial year, RIA purchased a machine from a German company at a cost of 600,000. The machine was transported to the manufacturing premises of RIA on 1 April 2018 at a cost of 28,300. So meaning that the cost of the machine is going to be 600 plus 28,300. Then it was installed and tested at an additional cost of what? Of 20,000. So the cost of the machine in 2018 is going to be 600 plus 28,300 plus 20,000. 648,300. Right. Then the machine was available for use as intended by management on 30 April 2018, and it was also brought into use on this date. So we are going to start charging depreciation on that date, 30 April 2018. The machine has an estimated useful life of 10 years and a residual value of 0 allocated to the machine. Then there is a delivery vehicle. RIA owns a delivery vehicle that was originally acquired on 27 February 2016 at a cost of 385,000. The delivery vehicle was available for use as intended by management on 31 March 2016, and it was brought into use on this date. On acquisition date, it was determined that the delivery vehicle had an estimated useful life of 250,000 kilometers, and the residual value of 0 was allocated to it. On that 1 December, the delivery vehicle has traveled a total of 136,520 kilometers, that is 2017, the previous year. Due to high odometer reading on the delivery vehicle, the management decided to sell the delivery vehicle to rather use a courier company in future. So on 30 April 2018, the delivery vehicle was sold for cash for 155,000 rands. So meaning that we are going to remove the delivery vehicle in our books on 30 April 2018 at carrying amount. Then during the 2018 financial year, the date of sale, until the date of sale, the delivery vehicle traveled a total of 26,592 kilometers. So in this case, we are simply saying we are going to charge our depreciation based on the kilometers that have been traveled by the delivery vehicle. So what is important is the accounting policy to see how we are going to be disclosing our information. So the first one is saying the following is an extract from the accounting policies of RIA Limited. Owner-occupied land is accounted for using the what? Revaluation model. So therefore, we are going to be showing our land at fair value. Our land is going to be shown at fair value. Land was revalued for the first time in 2017 financial year. It is company policy that revaluations will be made with sufficient regulatory to ensure that carry amounts do not differ materially from what that which would be determined using the fair values at the end of the reporting period. Owner-occupied buildings and machinery is accounted for according to the cost model. Owner-occupied, that is the property, plant, and equipment. Investment property is accounted for in accordance with what? The fair value model. So it means that the investment property, we are going to show it at fair value. The carrying amount of the investment property will be recovered through sale. So therefore, we are going to be accounting for capital gains tax, 80% of the amount that we are going to recover when we sell the asset. Depreciation on the buildings and machinery is provided for according to the straight line method over the useful life of the assets, that is the buildings and the machinery. Then depreciation on delivery vehicles is provided for according to the units of production method. In this case, it is based on the kilometers that have been traveled. The fair values of the properties were determined by an independent zone appraiser. So this information is important for disclosure purposes. So the values provided were determined with reference to current market prices of similar properties in the same location and condition. SARS allows the following capital allowances. So there is a 5% annual building allowance on both buildings, and the buildings that we have with building in the manufacturing property and the building in the office block altogether. So when we're calculating our deferred tax, we need to take note of that SARS is allowing an allowance on the office block and also on the manufacturing property. But when we are disclosing our investment property, it is not going to be depreciated for accounting purposes. But for SARS purposes, there is an allowance or a depreciation according to SARS, which is a tax allowance that is allowed. Do you understand? So we are going to look at that as we are moving. The fair values of the properties were determined by an independent zone appraiser. The values provided were determined with reference to the current market prices of similar properties in the same location and condition. SARS allows the following capital allowances: a 5% annual allowance on both buildings. So we have done that. Oh, that's what I was actually reading there. Then there's a tax allowance on machinery according to Section 12C of the income tax, allowing a 40% deduction in the first year the machine is brought into use, and thereafter it's 20. So it's 40, 20, 20, 20, and it is not apportioned. So even if it was there for 1 day, 40% tax allowance that is going to be allowed. A tax allowance on the delivery vehicles is 4 years according to the straight line method, and it is also, it is apportioned, this one. This one is apportioned. Transportation and installation costs will be regarded as of capital nature for taxation purposes. So the amount that was incurred in the transportation and the installation costs, SARS also says the amounts should be capitalized. Deferred tax is provided for on all temporary differences in accordance with the statement of financial position approach. There are no other material items causing temporary or exempt differences except those mentioned in the question. The company will have sufficient taxable profits and capital gains in the future against which unused tax losses can be utilized. Assumptions: assume that land and buildings are regarded as separate classes of assets. Assume all amounts are material. Ignore implications of VAT. Right, required. Our required is saying disclose the following notes to the annual financial statements of RIA Limited for the year ended 31 December 2018. Number 1, PPE. The total column is not required. So number 2 is investment property, and number 3 is deferred tax. Then we are going to prepare the journal entry according in the accounting of RIA Limited to account for the sale of delivery vehicle. So the delivery vehicle has been sold, so we are going to remove it using the journal entries part B. So you notice that they said disclose the information to the annual financial statements as at 31 December 2018. So first we check our year starts on the 1st of January 2018 until 31 December 2018. So that's what we are going to disclose in the annual financial statements. And make sure that you start by having the template. Right, the template. Right, because if you don't show the template, there is no marks. If you don't disclose, you don't get any marks. So we saw that on this question, there is manufacturing property, which we said is PPE. There is land and also buildings. Office block, we said it is investment property. There is also land and the buildings. There is a machine. There is also delivery vehicles. So on PPE, manufacturing property, land and buildings, a delivery vehicle, and a machine. So you write the name of the entity, it's RIA Limited. So that's what you start with, RIA Limited. Then you write notes to the annual financial statements for the year ended 31 December 2018. So you can start with number 1, property, plant, and equipment. I prefer 2. Even if you put 1, it's fine. Property, plant, and equipment. And then the PPE, we saw the items that we have. We said there is land, there is buildings, there is machinery, there is a delivery truck. So it's 4 items. So we start with the land, buildings, machinery, and the delivery truck. You can say it's a vehicle. Vehicles. So you write carrying amount at the beginning of the year, or you can write the carrying amount at what? 1 January 2018, constituting of the cost and its accumulated depreciation. Right, during the year, what was there during the year, good people? We see that the entity is using the revaluation model. So there will be a revaluation during the year. There will be additions, okay? There will be depreciation of the asset. There is obviously the disposal at what? At carrying amount. Then you jump lines in case of other things that we might have forgotten. We have our carrying amount at 31 December 2018, constituting of the cost and accumulated depreciation. Then remember here, you're going to disclose when, who, and the cost amount. So you state that the land was revalued by an independent zone appraiser on 31 December 2018. If the land was shown at cost, the land would have been the cost amount. So we're going to come and we disclose that information. Then we come to point number 2. We say it is our investment property.
Chief.
Okay, good people. I was lost. I'm found now. Can you hear me?
Yes, we can hear you now.
I don't know where I was now. That's the challenge now. Did we do this investment property?
You were just starting with investment property.
Okay. So the investment property, I got lost. So the investment property, you have your carrying amount at the beginning. Then you have your additions, fair value adjustment, carrying amount at 31 December at the end of the year. Then you have your deferred tax. Then you have your deferred tax. Right. So
Sir, sorry, sir, you're writing.
yes, I already. That means that I was teaching alone. Can you see now?
Yeah.
Okay. Right. It means that I was teaching alone the investment property, but you know how to do it. We have covered it. Right. Now, you start with the 3 marks, good people, the easy things in the examination. So I can easily start with my investment property. Investment property was acquired on the 1st of February 2018, which is during the year. It is during the what? The year. Are we together? So meaning that there was an addition due to acquisition of the asset. Is that clear? That is our addition. So we are going to come under investment property. We added land of 1325 and added a building of 3895. Okay, so it's 1325, the land. 1,325,000. The building is 3,895,000. The total is 5,220,000. Right. Happiness. There was nothing at the beginning of the year. What we put at the beginning of the year is what was there as a closing balance in the previous financial year. Do we agree? Are we still there?
Yes, sir.
Okay. Yeah, if you keep quiet, but I'm all right. Then remember they said the policy of the entity is to show the investment property at fair value. So the fair value of our investment property, the land was 1.4 on 31 December, and the buildings was 3,950. So I'll come and I put my 1.4 and 3,950. Then 1.4 plus 3,950 will give us 5,350 minus 5,220, getting a difference of 130. So the 130 is your fair value adjustment. So it will be 1.4 minus 1,325 for the land, you get 75,000. And the building is going to be 3,950 minus 3,895, 55,000 plus 75, we get 130. So it's all fine. Then below, you are going to state that the property was revalued on which date, by and by who. So here you state who, and when. So then you're going to say the property was revalued on 31 December 2018 by an independent appraisal. Happiness. Are we together?
Yes.
All right. Then we are done with the investment property. Ipeli, any questions, additions, or subtractions on investment property? Nothing. Now we go to PPE. Now PPE has got three items. There is the manufacturing property, where there is land and the buildings. There is the delivery vehicle, and also there is machinery. So you choose also which one is easier for you. Let's start with the machinery. Now, the machinery was acquired on the 1st of April 2018. It is in the current year. Are we together? For 600,000. Then they added transportation. We're going to add the transportation cost, because we say the cost of the asset is the cost of bringing the asset to its present location and usage. Take note, our year starts from the 1st of January until 31 December. So the machinery was not there at the beginning of the year. So we are going to put 0 there. There is no machinery there is no cost of the machinery at the beginning of the year. Nothing. Then we are going to look at the cost of our machinery. The cost of the machinery is the cost of bringing the asset to its present location and usage. So the cost is going to be 600,000 plus the transportation cost of 28,300 plus the testing cost of 20,000, the cost of testing. So the cost of the machine is going to be 600,000 plus 28,300 plus 20,000. So you're going to get a cost of 648,300. So that is the cost of the machinery. So our addition, I'm going to put 648,300. That is the cost of our machine. Are we together? Then you are going to look at your depreciation. Now, our depreciation is going to be charged when the asset is ready and available for use until the end of the year. So how much is our depreciation in the current year? So it was available for use on 30 April, and it has the useful life of 10 years. The residual value, it's 0. So our depreciation in the current year, please, this you are doing it in the second page where you are going to write calculations. I'm just showing it here because I want you to see what we are dealing with. So it will be 648,300 minus the residual value of 0 divided by useful life of the asset is 10 years multiplied by it was ready from 30 April 2018. So April is done. So it will be May, June, July, August, September, October, November, December. I'm getting 8 months out of 12 to convert it into years. So it's May, June, July, August, September, October, November, December. It's 8 months. So our depreciation is going to be 648,300 divided by 10 multiplied by 8 over 12. I'm getting 43,220. Please confirm with me. Good people.
Correct.
Correct.
Okay. So you put your depreciation, it's 43,220. Right. Nothing happened to the machinery at the end of the year. So the cost is still the same, 648,300. And accumulated depreciation at the end of the year will be the opening balance plus the amount in the current year. Then you get your closing balance. So it will be 0 plus 43,220. So it will be 43,220 there. Then you get your carrying amount of your machinery. So it will be 648,300 minus 43,220. You get 605,080. Happiness. Right. Then we move on to, you can choose the land, buildings, and the vehicles. Let's start with the vehicles, it's fine. Right, we come to the vehicles, the delivery vehicle. Now, our delivery vehicle, they said they own a delivery vehicle that was originally acquired on 27 February 2016. Remember, our year starts on the 1st of January 2018 until 31 December 2018. So the delivery vehicle was acquired in the previous years at a cost of 385,000. So the cost of the vehicle, you can put your cost of 385,000 there, right? Then it was available for use as intended by management on 31 March 2016. So that's when you're going to start charging your depreciation. And it was brought into use on this date. On acquisition date, it was determined that the delivery vehicle had an estimated useful life of 250,000 kilometers. So we are going to depreciate our vehicle based on the kilometers that it is expected to travel. And the residual value of 0 was allocated to it on that 1 December 2017, which is the end of the previous year, which will be the beginning of the opening balance of the 2018 financial year. The vehicle had traveled 136,520 kilometers. So we are going to calculate the accumulated depreciation at the beginning of the year. Remember, the closing balance of the previous year is the opening balance of the current year. So the current accumulated depreciation at the beginning of the year is going to be the cost of 385,000 multiplied by the kilometers that were traveled in that year, 136,520, divided by the total kilometers that the entity is expecting the asset to travel. So it will be 385,000 multiplied by here. There is no dates that we are going to be using. We are going to be using the kilometers that are going to be traveled. So it will be 385,000 multiplied by 136,520 divided by 250,000, 210,241. Right. So our accumulated depreciation is 210,241. Are we following? Are we still there?
We are here.
Yes.
All right, it's fine. 210,241. Right. Then our carrying amount minus 385,000, you get 174,759. right, 174,759. Then we are going to charge the depreciation in the current year. So the depreciation in the current year, remember, the delivery vehicle was sold on 30 April 2018. We stopped charging depreciation until that date. The delivery vehicle was sold for cash for 155,000. During the 2018 financial year, until the date of sale, the delivery vehicle traveled a total of 26,592. So the depreciation in the current year will be 385 multiplied by the kilometers that were traveled until 30 April 2018, 26,592 divided by the total useful life, which is 250. So it will be 385,000 multiplied by 26,592 divided by 250,000. I'm getting, how much are you getting? Good people?
It's 40,952.
40,052. So that's what we are going to show as depreciation, 49,552. Now, the vehicle has been sold. So we are going to dispose it at carrying amount. That's when you are going to remove it from your books. You remove it at what? Carrying amount. And carrying amount is your cost minus your all accumulated what? Depreciation. So in this case, our cost is 385,000. You take out the accumulated depreciation of 210,241. You also take out the depreciation in the current year of 49,552. So it will be 385,000 minus 21,0241 minus 49,552. I'm getting 133,807. So at the end of the year, there is no vehicles. Alternatively, you can show it by using the carrying amount that we have here of 174,759 minus the depreciation in the current year of 49,552. So either way. So if you're using the cost, take every depreciation that is there. If you're using the carrying amount, just use the carrying amount at the beginning of the year minus the depreciation that has been charged in the current year. Questions, additions, or subtractions? All right. Now, there is something that they asked there. They had asked us to prepare the journal entries in the accounts of RIA to correctly account for the sale of the delivery vehicle on 30 April 2018. So we want to remove the delivery vehicle from the books. Now, when we are removing the delivery vehicle from the books, we have to remove the delivery vehicle, number one, at cost, and remove the delivery vehicle, using its accumulated depreciation. My statement is wrong. We have to remove the delivery vehicle at its carrying amount. But remember, in the books of accounts, the delivery vehicle has got two accounts that are there. There is the vehicle at cost and also the accumulated depreciation. So we have to remove the vehicle. We are removing its cost and we are also removing its accumulated depreciation. So when preparing our journal entries, we come and you put our debit and our credit. So how do we remove the vehicle? So first, your cost is an asset. It has got a debit balance. Your accumulated depreciation is reducing the cost of the asset, it has got a credit balance. So the one with a credit, you are going to debit it, which is your accumulated depreciation of the vehicle. It will be 210, 241 plus the depreciation in the current year, 4952. So it will be 210, 241 plus 4952. 4952, you get a total of 251. How much is it? 251, 193. So I'll put my 251, 193. Then you credit your cost, the vehicle at what? At cost. The cost of the vehicle is 385,000. Together. Then we know that the entity received the money when they sold this asset. They received cash. So we're going to debit our bank by 155,000. So you debit the bank. So the account is not balancing. So the balancing figure is going to be a profit, or it can be a loss. Are we together? So if the disposal is greater than the carrying amount, it's a profit. So it was 385,000 minus 251, 193. You get a carrying amount of 133,807. It was disposed at 150, so you subtract 155. So there was a profit of 21,193 on the credit side. So this is going to be profit on sale of delivery vehicle. Happiness.
Sir, can I please ask?
Yes, ma'am.
Hello?
Yes, I can hear you.
Okay, just pardon me with my network. Can you hear me, sir?
Yes, I can hear you.
All right. I just want to understand why would we sell maybe a vehicle at its cost, like right at the beginning, where like time went on and depreciated, but its value, why can we not sell it on its book value?
Okay. Now, when we open our asset register, the asset register will be showing the vehicle at cost. So this one is showing our historical amount without any depreciation. Then we also have another account which is called accumulated depreciation. So we will be wanting to separate the value of the vehicle using these two accounts. So we'll be having the vehicle at cost to say the original cost of the vehicle was 385,000. So in that account, we will only be putting cost and taking out also the cost. Then any accumulated depreciation will be having a separate account where we will be calculating or putting the depreciation in that account. So all the depreciations relating to the vehicles will be put under accumulated depreciation of the vehicles. So we are just separating the two accounts. Under normal circumstances, you are saying you prefer to have the asset at its what? Book value. But if you check under our PPE there, we also showed the same. We showed that the cost, if you go to the cost, the asset account, at cost, you find that the cost is still 385. Then you also go to the account that reduces that value, which is the accumulated depreciation. So in this case now, we are saying those two accounts that the entity is having, we need to remove them because they relate to the vehicle. So there is the vehicle at cost and also its accumulated what? depreciation. So we don't have the vehicle at its carrying amount in the books, but we have the vehicle at its carrying amount in the statement of financial position, because we're just showing its carrying amount because we've done the calculation. We have, so now when you come now to disclose your PPE note, you're going to show to say, no, when the asset was bought, it had a value of 385, and we calculated the total depreciation since it was bought until today, the amount is this much. So you are just separating the two accounts only so that the users will be able to follow what is happening on that asset. Is that clear?
Okay, it's clear.
Yes.
It's clear. Thank
So
you.
it is two accounts that are just there, but it's okay to say you should remove it at carrying amount, but we are saying there is a vehicle at cost account. So in the cost account, we add cost, we remove cost. So in this case, when it was bought, we added a cost of 385. Now we are removing that vehicle. We also remove it at its what? At its cost. Then accumulated depreciation. Those are the depreciations that were being added all over in all these past years. We also have to remove everything on the vehicle that was added in the accumulated depreciation account. All right. So,
Thanks, it's clear.
all right. Yeah, see Pambi. Right. So we are done with our vehicles, the journal entry. Now we are left with the land and the buildings. Now, when we come to our land, we are now on manufacturing property. The land, they said it should be shown, they are revaluing their land. So if the land is revalued, we are going to show it at what? At its fair value. Now, the land was acquired on the 1st of February 2017. Our year starts on 1 January 18 until 31 December 18. So it therefore means that the land was acquired in the previous year. It was acquired at a value of 1.5 million. But remember, the entity is showing the land at fair value according to the notes. They are using the revaluation model. So when we look at this, at year end, 31 December 2018, which is the end of the previous year, which will become our opening of the the fair value of the land on 31 December 2017, the end of the previous year, which is going to be the opening of the current year. The value of the land was 1,750,000 and 1,875 on 31 December 2018. So we need to disclose that the opening balance was the closing balance of the previous year. So the closing balance of the previous year is 1,750,000. So we are going to come and we say cost, then you write slash gross carrying amount, because it's no longer the cost for the land. It is now the revalued amount, and we call it the gross carrying amount, and it is 1,750,000. So there is no depreciation for land. So we are going to put 1,750 there. So it is done at the beginning of the year. Then at the end of the current year, it is 1,875,000. You're going to come and show it under the cost. You put slash gross carrying amount to show that this is the revalued amount. So our gross carrying amount is 1,875,000. So put 1,875,000. There is no depreciation, 1,875,000. So we can see that 1,750 and 1,875,000 are not equal. So therefore, there was a revaluation during the year of 1875 minus 1750. So say 1875 minus 1750 will give us 125,000. So the land has been revalued. Any questions? Good people? Hello.
Nothing, sir.
Okay. Then remember, we said we are supposed to disclose when, who, and the cost. So you are going to come and you say the land was revalued on 31 December 2018 by an independent sonar appraiser. Are we together? Then you state that the carrying amount of the land, if it was carried under the cost model. So if it was carried under the cost model, would have been how much? If the land was shown at the cost model, the value of the land would be how much? Good people? Are we still there?
Yes, sir.
Yes, what is the value of the land if it was shown under the cost model? You don't have the question there.
Is 187, isn't it?
No, the 187 is the value, the revalued amount. Now I want to say how much was it supposed to be shown as if it was shown at cost? Okay. Right, we have got three amounts here. We have got an amount of 1.5. We've got an amount of 1,750 at the beginning and an amount of 1,875. So they are saying if this land was at cost, the carrying amount would have been how much? People, how much was going to be the carrying amount?
1.5.
Sorry?
It's not 1.5.
Yes, it was going to be 1.5. That's the original cost of the land. So it would have been how much? 1.5 million. Just like that. So the value of the land would have been 1.5 million. Questions, additions, or subtractions? In the absence of any, let's go to the buildings. Now, the buildings, what happened? Now, our buildings, they began construction in 2017 financial year. Right, our year starts on the 1st of December, 1st of January, 18 until 31 December, 18. But it was the buildings, the land was acquired in 2017 without a building. Then they began construction with the construction of a manufacturing building in 2017, that is the last year. During the 2017 financial year, construction costs of 5 million were incurred on this building project. So last year, we closed off with 5 million. So there won't be any depreciation in the previous year because the building was not yet ready and available for use. Is that clear? So you put 5 million, no accumulated depreciation. Why? Because the building was not yet ready for use. Then in the current year, that is, it was completed on 31 January after additional cost of 1 million. So you come and you put your additions of 1 million in the current year. So meaning that at the end of the year, the cost of the building is going to be 6 million. Is that clear? Right. Then we are going to charge our depreciation from the date the asset was ready for use. It was ready for use on 31 January 2018. Are we together? So our depreciation is going to be, the cost of the building is 6 million minus a residual value of 600,000. We divide it by the useful life of the building. They said it's 30 multiplied by the time it was there in the year. It was ready on 31 January 2018. So it would be February, March, April, May, June, July, August, September, October, November, December, which is 11 months out of 12 months to convert it into years. So it is going to be 6 million minus 600,000 divided by 30 multiplied by 11 divided by 12. I'm getting depreciation of 165. So your depreciation is 165,000. Then accumulated depreciation at the end will be 165, opening plus 165 minus 6 million, 5,835,000. Happiness.
Yes.
Okay, so then it's done. Then the next part was saying disclose deferred tax. Now, our deferred tax, that's point number 3. You did deferred tax with Tulisan in FAC3701. Maybe you're doing it now. So you should be able to teach me it deferred tax. So the deferred tax, we will be looking at the amounts that are different from SARS. So the carrying amount versus the tax base is going to be different. So there are 2 ways that you can look at it. You can have your analysis in temporary differences. Right, so they can ask you to show the calculation in terms of a table, or if they are silent, you can just come and you look at the okay, let's do it using a table first. Right, how can I show it? At page. All right, let's start with the property, plant and equipment. the manufacturing land. So the land, obviously, you'll be having the carrying amount. You have an amount that was revalued. You have your exempt amount. Temporary difference. We have your deferred tax asset or liability. So if we are to look at our land, good people, when it was acquired, its cost was 1.5 million. That was in 2017. 1 February. Then on carrying amount, 31 December 2017, the carrying amount of the land, you can actually check it from our PPE, it was 1,750. So meaning that there was a revaluation in 2017 of 1,750 minus 1.5 million, 250,000. Altogether. Then the amount that is exempt is 1.5. So there is a difference of it's actually an exempt difference of 250,000. And we know that this is going to be recovered when we sell the asset. So it will be 250,000 multiplied by 0.8 by 0.28, we get 56,000. And it is a liability. Then we come to the year 2018, carrying amount at 31 December 18, the closing balance is 1,875,000. Meaning that there was a what? A revaluation of 1,875 minus 1,750 was a revaluation of 125,000 there. So we put our 125. There is no revaluation. So we have 125. Revaluation in total is going to be 250 plus 125. I'm getting 375. Exempt is still 1.5 million. 375. So 125,000 by 0.8 by 0.28 is giving you 28,000 liability. If your carrying amount of an asset is greater than your tax base, it is a liability. If your carrying amount is less than your tax base, it is an asset. So plus 56,000, 84,000, and it is a liability, which is 375,000 by 0.8 by 0.28, which is 84,000. So what we have done now here is we have seen that there is a revaluation of manufacturing property of the land. So you can come and you say there is a revaluation of the land manufacturing building, 84,000. Now, you can actually do it easier without the table, because we know that the cost of the asset and the carrying amount now is now different, and the revaluation was based on the carrying amount at the end of the year. It is 1,875,000. The asset was originally acquired for 1.5 million. So you come and you put your 1.5 million, and we know that the difference between these two is the revaluation. So there's capital gains tax multiplied by 28% without the table. But sometimes they might need you to show it using the SFP approach. So 1,875 minus 1.5, you get that 375 that we have here, multiplied by 0.8 by 0.28, you get your 84,000. Okay. Then we also have another revaluation for investment property before we go to the accelerated tax allowances, the amounts that are allowed to be deducted by SAS. So we've got the fair value adjustment. We have the fair value adjustment of the land and the fair value adjustment of the building. So let's start with the land. So it is very easy for the land. Where is our investment property? Our land, it is just going to be 1.4 minus 1,325, which is your 75,000 there. Is that clear? So the fair value adjustment of the land will be 75,000 multiplied by 80% multiplied by 28%. So 75 by 0.28 by 0.8, you get 16,800. It is also a liability. Now we come to the buildings. Investment property of the building. Now, the building investment property, you obviously have your carrying amount. You have fair value adjustment. You have the building at cost. You have your tax base. Temporary difference, deferred tax asset or liability. Are we still together, good people? Okay.
Yes, it's
Yes,
still
we are.
Yes, sir.
Okay. Now, the building was acquired on the 1st of February 2018. So we can say cost 1 February 18. The building had a cost of 3,895,000. There was no adjustment. The cost was 3,895,000. Tax base was 3,895,000. There was no temporary difference. During the year, there was a fair value adjustment. SAS, they gave us a policy to say it is a 5% annual building allowance on both buildings, according to Section 13(1) Queen of the Income Tax Act, not apportioned. So the building had an allowance of 5%. So there was a tax allowance of 5% according to SARS. Tax allowance of 5%, it is 3,895,000 multiplied by 0.05. It was an allowance of 194,750 according to SARS. There is no depreciation, there is no depreciation, there is no depreciation. But we know that at the end of the year, the asset was shown at fair value, it was revalued. So carrying amount at 31 December 18, the asset had a carrying amount of 3,950,000, that is the buildings. So it is 3,950. So there was a fair value adjustment of 3,950 minus 3,895. There was a fair value adjustment of 55,000. 55. Cost, there is no fair value adjustment. SARS does not recognize that. So we have 55,000 there and 194,750. Right. So I prefer to use 55, the closing balance 3,895,000. And then no, tax base, there is nothing here, sorry. SARS does not revalue assets. So we got 3,895,000 minus 194,750. It will give us a tax base of 3,700,250. Right. Now, when we look at this now, the fair value adjustment of 55,000 is going to be recovered through sale. Are we together? Then the 194,750 on the cost of the asset is going to be recovered through use. So the amount that is going to be recovered through sale, it is going to attract capital gains tax. And the one that is going to be recovered through use, it will be just the amount by 28%. So 55,000 is going to attract capital gains tax. So the deferred tax asset or liability is going to be 55,000 multiplied by 80% multiplied by 28%. So 55 by 0.8 by 0.28. I'm getting 12,320. And it is a liability. Then the 194,750 is allowed by SARS. It is going to be recovered through use by 0.28. There is no capital gains. So it will be 194,750 by 28%. I'm getting 54,530. So all in all, it will be 54,530 plus 12, 66,850. That is the total amount of deferred tax, which is 66. But when disclosing, we're going to disclose it separately under deferred tax. There is an amount that is going to be having our fair value adjustment of the building is going to be your fair value adjustment that you made of 55,000. By 28% by 80%. And we got 12,320. Do you remember how you got the 55,000? It is the fair value of the asset minus the cost at the end of the year. Then we have what we call the accelerated tax allowances. These are amounts that are allowed by SARS, but they are different from our carrying amount. So the tax base and the carrying amount is different. So we can start with this building that of ours, because we've done the calculation already, to say there is a temporary accelerated tax allowance of 54,530. So I'm going to come and say 54,530. It is also a, so this is the buildings for investment property. Then we can have another building for PPE. So the building for PPE, we can come and we do the calculation again for deferred tax. But I think it will be just a hassle. So we have our carrying amount, tax base, temporary difference, and deferred tax asset or liability. This one is not complicated because nothing was revalued. Is that clear? So can I just use the, okay, can just use it from the beginning when it was bought. The land at the cost of, in total, of 6 million. So I'm going to say when the asset was ready and available for use, it had a cost of 6 million. SARS also saw this asset having a cost of 6 million. Now in 2015, remember, in 2016, there was no activity because the asset was not yet ready and available for use. SARS will start charging tax allowances when the asset is being brought to use. So it was not yet brought into use in the previous year. So in the current year, there was a, can you hear me? Hello?
Yes, we can.
So in the current year, there was a tax allowance. And also there was what? Depreciation. Now, depreciation on the building, we did it already. It is 165,000. So you're going to come and you show your 165, that is the carrying amount of the building. Then the tax base, they said there is a 5% allowance on the asset. So it's 5% times 6 million. What we get, 0.05 by 6 million, we get 300,000. I just prefer to use the carrying amount at the end of the year. So it will be 6 million minus minus 300,000. We get 6 million minus 300,000. 5,700,000. Then 6 million minus 165,000. 5,835 minus 5.7 million, you get 135,000. So that you multiply by 28%, you get your 37,800. tax allowance. So you're just going, so in the examination, you just have to know that I'm calculating the carrying amount versus the what, the tax base, how much depreciation has been charged on the asset from when it was bought until now, and how much tax allowance has been allowed by SARS from when it was brought into use until today. So then you get your 37,800. So that's your accelerated tax allowance of the buildings, which is 37,800. We're done. Then the other asset is the machinery. Let's look at the machinery. You do the same principle that we have here. Now our machinery, let me use a different color. Machinery. Same carrying amount, tax base, temporary difference, deferred tax asset or liability. Right. So the carrying amount, I can just now do the simple way. You now know the carrying. Okay, let's just start with the cost. It's fine. So my cost of the machinery is 648,300. Tax base, they said they will allow everything. Then our depreciation or tax allowance, depreciation for the machinery, we've done it 43,220. Then the tax allowance for the machinery, they said how is the tax allowance on the machinery for SARS? A tax allowance on the machinery according to section 12C of the Income Tax Act, allowing or a 40% deduction in the first year. So this is the machinery's first year. So we are going to allow 40%. So it will be 648 multiplied by 40%. How much do we get? 648,000 by 0.4. We get 259,200. Then you get your carrying amount at the end, 259,200 minus 648,300, getting 389,100. Then carrying amount 648,300 minus 43,220, 605 minus 389,100, 15980. Then the 215 is a temporary difference. You multiply it by 0.28, you get your 60,50,6474. Mm, 60,474. Did I calculate my things correctly? Put people. Are we still there?
Yes.
Yes.
I need it 648,300 by 0.4. 259,320.
Yes, sir.
No, it's fine. It's 320 minus 648,300. I'm getting 388,980 minus 4 plus 605,080, 216,100. .28, 6508. 6508. So that's what we put as accelerated tax allowance on the machinery. 60,508. Did we understand deferred tax? It's a challenge to many. So I always tell people, if it's kicking you, don't write it in the exam. You will still get a distinction. But for you guys, I know you're going to write it and manage to fully account for deferred tax. Now, look at the 2019 assignment 1, first semester, and our assignment 2 is the one that we did just now. Then you can also look at 2020 assignment 1, first semester, and assignment 1, second semester. I think I shared the answers and the questions on the group. Now you are just preparing yourself, or you are just practicing on property, plant, and equipment altogether. So we have other situations whereby investment property is converted into PPE, or PPE is converted into investment property. So we're going to look at that at a later stage. So our next topic that we're going to be looking at is what is called intangible assets in the next class. So I hope you follow. And remember the assignment, we did it last week. So I hope you are writing it. If you have challenges, you can just call me. I will help you. Any questions, any additions, any subtractions?
No questions.
Okay. In the absence of any, let's have a wonderful evening.
Thank you very much. Bye.
Thanks, bye.
Thank you. Thank you. Bye.